The Dinar isn't, or T, fine, just because the official number is unchanged. Because the real story is the spread, and that spread is widening exactly as controls tighten. They can repeat the rate is stable and point to a budget anchor, but the street is printing a different receipt, and once the market sees that receipt, it doesn't unsee it. Stay with me, because in a few minutes, you'll have a simple, ruthless checklist for what to watch over the next week or two, the specific levels that matter, and the one hidden detail that explains why this keeps happening, even when the central bank swears nothing is changing. Here's the live tension. On paper, the official framework stays pinned, and that's the headline everyone wants you to stare at. But in the parallel market, the dollar has been trading in the mid-146,000s to high 147,000s per $100 in Baghdad this week. And Erbil's been right in the same neighborhood. That means the real clearing price for cash access is nowhere near the official anchor used in policy and budgeting. And that gap is the pressure gauge, not because the currency suddenly broke, but because access broke. And that's where the real pressure starts. Now, don't let the word spread sound abstract, like a finance word that lives on a Bloomberg terminal. In this setup, the spread is simply what people pay to skip the line. It's the premium for certainty. It's the extra cost to get dollars now in hand without waiting on approvals, paperwork, correspondent reviews, or the kind of compliance checks that turn a routine import payment into a multi-week headache. And when that premium jumps, it's almost never emotion first. It's flow first. It's plumbing. The next detail is what flips the whole setup. Because the hidden detail most people miss is this. The official rate. Isn't a T really a price? It's a subsidized allocation mechanism. Read that again, slowly, because it changes how you interpret every headline you're about to see. In a true free market, price is the lever that balances supply and demand. In a controlled system, access is the lever. The official number is what you get if you qualify, if you're in the right channel, if you're approved, if the system decides your demand is allowed demand. And the moment those gates narrow, the official rate becomes less relevant to price discovery and more relevant to who gets rationed. That's not a conspiracy. That's just how controlled distribution works, whether it's foreign exchange, fuel subsidies, or anything else where the state is trying to manage scarcity. And it gets even more specific because even inside the official world, there are multiple effective official prices depending on what you're doing. In the central bank's own selling window language, you'll see distinctions like the rate applied to remittances and card settlements versus the cash selling price. Numbers clustered around the low 1300s per dollar. That might sound like a tiny nuance, but it's the tell. It means the system already admits, in practice, that not all dollars are equal. A dollar that clears through an electronic channel with documentation is not the same as a dollar that clears as cash in the street. One is slow, supervised, and rationed. The other is immediate, anonymous, and therefore scarce. But that's not the part that matters. The part that matters is timing. Why now? Why does this flare up this week instead of quietly simmering? Because FX stress almost always spikes around calendar friction. Early month payroll cycles, import settlement windows, customs processing changes, weekend gaps that thin liquidity and make dealers pull their quotes. And, crucially in Iraq's case, moments when the authorities are trying to push more activity into the formal channels at the same time, the private sector still lives in the real economy, where speed and certainty often beat price. When the system tightens and the calendar demands dollars at the same time, the spread doesn't drift. It jumps. Think about what a tightening actually means on the ground. It doesn't mean someone announces we are tightening and then the price obeys. Tightening means the throughput of the official pipeline slows. It means more documentation, more scrutiny, more checks on where the dollars are going and whether transactions fit the rulebook. It means commercial banks, correspondent banks, and payment rails become the new bottleneck. And when that bottleneck bites, the effective supply of dollars to the real economy shrinks, even if reserves look fine and the official rate hasn't moved a millimeter. That's why the spread is so dangerous as a signal. It detects shortages of access, not shortages of reserves. And that's exactly the kind of shortage that creates sudden, ugly moves. Now let's make this mechanical, because if you can explain the mechanism, you can forecast the next likely behavior. Picture two doors to the same building. Door A says official rate. The bouncer is strict. You need the right paperwork. You need approvals. You need a reason that passes review. Door B says street rate. The bouncer barely asks anything, but the line moves fast. So when door A gets stricter, you don't just get fewer people through door A. You get a stampede to door B, and door B doesn't have infinite supply. Dealers have inventory limits. They manage risk. They widen spreads. They raise prices to slow demand and protect their stock. That's the reflexivity. It feeds on itself. And in a dual rate system, price discovery doesn't disappear. It relocates to the fastest clearing venue. That's why you can see a stable official anchor and a screaming parallel market at the same time. They are not contradicting each other. They're describing two different realities, the administered reality and the clearing reality. The mainstream headline will act like only one can be true, but the market lives in both. And if this one level breaks, the math changes. So let's stack proof, not vibes. First proof is simply the tape. Market surveys in Baghdad and Erbil have shown the dollar opening and closing in the mid 146,000s to high 147,000s per $100 over recent sessions. That's not a rumor. That's what exchange points are printing. Second proof is the anchor behavior. The central bank and officials have repeatedly emphasized they're not changing the official rate, and the 2026 budget framework is being set around a fixed exchange rate level. In other words, policy is trying to reassure the public and reduce expectations of devaluation. Third proof is the policy architecture itself. Officials have described explicit measures aimed at eliminating the gap, pushing domestic transactions away from dollars, routing transfers through correspondent banks, bringing more trade finance into formal banking channels, expanding electronic card use, and using state-backed distribution channels to stabilize prices for key imports. Those are not measures you take when everything is perfectly normal. Those are measures you take when you're trying to drag demand out of the street market and back into the supervised system. And that's where the real pressure starts. Fourth proof is institutional, and it matters. The IMF has praised the transition to a newer trade finance framework managed by commercial banks through their correspondent relationships, noting that it contributed to reducing the spread between official and parallel rates in the period they assessed. That's the key phrase, through correspondent relationships. Translation: the system is trying to move away from a looser window model toward a monitored bank-to-bank model with AML CFT scrutiny. That's structurally bullish for control, but it's structurally restrictive for speed. It narrows the set of transactions that clear quickly. Fifth proof is historical behavior. Local reporting and official remarks have acknowledged that the parallel rate has, in past spikes, run far above the official level, at times peaking dramatically before stabilizing closer again. That's the signature of a market where access cycles between available enough and choked. When access is choked, the parallel market overshoots. When access loosens, it mean reverts. The next detail is what flips the whole setup. Because once you accept that this is about throughput, not just rate, you can start watching the real leading indicators. And those indicators don't live in a speech. They live in frictions. Are small importers getting routed into official channels or pushed out? Are banks delaying certain categories of payments? Are documentation requirements changing midweek? Are card settlement rules being tightened? Are enforcement campaigns reducing street supply? These are the micro signals that tell you the spread will either compress or blow out. Now, there's a trap here for retail minds, and it's a trap institutions love because it keeps the public looking at the wrong thing. The trap is thinking, if the official rate is 1,300 per dollar, then the currency is priced at 1,300. No, the currency is being allocated at 1,300 to approved flows. The clearing price for marginal dollars, the last dollars needed by someone who can't wait, is higher. And marginal pricing is what moves markets. Marginal buyers set the next print. Not average buyers, not budget assumptions, marginal stress. That's why the spread is the story. Now let guess talk about the controls tightening high part without turning this into cartoon villain talk. Tightening doesn't have to mean someone is malicious. Tightening can be a rational response to external constraints. Correspondent banks have risk appetites. Global regulators have AML expectations. International financial networks get sensitive about where dollars end up. And when scrutiny increases, the operational result is the same. Fewer transactions clear, or they clear slower, or they require more proof. That is a liquidity event, not a monetary event. Liquidity is not just how many dollars exist. Liquidity is how many dollars can move right now through channels that count. And when liquidity breaks, the street reprices instantly. Here's what that forces participants to do. Importers, wholesalers, and anyone with hard obligations can't tell their supplier, sorry, the bank is processing my paperwork. They either deliver or they don't, so they become forced buyers. They pay up in the parallel market to meet a deadline. Meanwhile, dealers see that urgency and protect themselves. They reduce the size they'll sell at any given quote. They widen their bid ask. They raise prices to ration their own inventory. The act of tightening creates the spread. The spread then creates fear. Fear creates hoarding. Hoarding creates more spread. That's reflexivity. And it's why these moves look vertical even when the underlying cause is bureaucratic. Now, let's address the easy arbitrage crowd because I can already hear it. If the street price is higher, why doesn't everyone buy cheap dollars officially and sell them on the street? That's exactly the point. In a controlled system, the bridge is what's restricted. Arbitrage only works when you can move the asset between venues. If you can't move dollars freely from the official channel to the street channel, because approvals, monitoring, compliance, and enforcement are designed specifically to prevent that, then the spread can persist. It can widen, it can gap, and it can stay irrational longer than your tidy model expects, because the model assumes frictionless transfer. Here, friction is the product. So what should you be watching right now, this week, this month? You watch the spread like a credit spread. Treat it like a stress barometer, not a currency quote. When the spread widens, it's telling you that access risk is rising. When it compresses, it's telling you that the official pipeline is clearing more demand, or the street is being squeezed by enforcement, or both. And that's not just academic. It has direct consequences for inflation, business confidence, and the political pressure on authorities to do something, which can mean anything from loosening certain channels to cracking down harder. But that's not the part that matters. The part that matters is how this resolves, because there are only a few ways a widening spread can end. One way is supply. The official channels increase throughput. More payments clear, more trade finance gets approved, more legitimate demand gets served at the anchored rate. That pulls the street down because the marginal buyer disappears. Another way is demand destruction. Prices spike, people panic by dollars, then realize they overpaid, and the market mean reverts as urgency fades. Another way is force. Enforcement squeezes street supply, or policy changes where dollars can be used domestically, pushing behavior into dinars. That can temporarily compress the spread, but it can also create hidden shortages elsewhere. And the final way is the ugly way. The anchor eventually moves. That's the one authorities want to avoid, and it's why they emphasize stability so strongly. But you don't need to predict that to trade the stress. You just need to watch the signal. Let's get concrete with levels, because vague talk is useless. The psychological battlefield right now is around the mid 140,000s to high 140,000s per $100 in the parallel market. When you see consistent prints above roughly 148,000 per 100, that's the market telling you stress is not fading. It's persistent. It's a regime for the moment. When you see it slipping and holding below the mid 146,000s, that is your first hint the squeeze is cooling, either because throughput improved or because demand urgency was satisfied. And if you see a clean acceleration toward the 150,000 area and above, that's where the math changes again, because it becomes a headline event. It becomes inflation fear. It becomes a political problem. And political problems create policy responses, sometimes messy ones, sometimes abrupt ones, sometimes overnight. That's where the real pressure starts. Now, you might be thinking, okay, but what's the controls tighten catalyst everyone is whispering about? Local context matters, and the details can vary week to week. Customs processing changes, documentation standards, bank procedures, enforcement sweeps, new monitoring systems. You'll hear different names, different acronyms, different explanations. The point isn't to marry one rumor. The point is to understand the category. Anything that slows the legal trade finance pipeline can spike the street price, even if reserves are fine and policy is unchanged. That's why I keep bringing you back to throughput. The market is not voting on the government's speech. It's voting on how fast dollars clear. And you should understand the institutional incentive here, because it explains the whiplash. Authorities want a narrower spread because a wide spread is a tax on the real economy. It raises import costs. It leaks into consumer prices. It undermines trust. It encourages dollarization. So they push people into dinars domestically, they restrict dollar use, they route transfers through more supervised channels, they expand electronic payments, they try to starve the parallel market. But at the same time, if you clamp too hard, you create shortages of access that force real businesses into the street anyway. That's the policy dilemma. Tighten to control leakage, but loosen enough to keep commerce flowing. And the spread is the scoreboard. Now we have to talk about risk, because this is where viewers get emotionally manipulated. Price can whip violently even if the core thesis is correct. You can be right about stress and still get wrecked by timing. Why? Because this market trades like a volatility instrument. The parallel rate can spike on thin liquidity, retrace on a rumor of relief, spike again on an enforcement headline, then drift for a week like nothing happened. That's not random. That's the market hunting for weak hands. That's your psychology being targeted. And the way you defend yourself is not by predicting every tick. It's by separating trend signal from noise. Here is the simple shield. The trend signal is the spread staying wide across multiple sessions and across regions, not just a 1-hour flare. Noise is a one-day jump on a thin session that reverses immediately once liquidity returns. Trend is when the market can't re-enter the prior range even after a pullback. Noise is when it snaps back into the old range and stalls. And that's not the part that matters. What matters is your decision rule. Decide in advance what would change your mind. Decide in advance what confirmation looks like. Decide in advance what invalidation looks like. Because if you don't, the market will decide for you in the worst emotional moment, right when your brain confuses urgency with certainty. That's how people get played in FX stress episodes. They chase late, they panic early. They buy the peak of fear and sell the first bounce of relief. Don't do that. Use structure. So here are the two scenarios that matter over the next week or two, and the tells that separate them. Scenario 1 is the controlled pullback and retest. In this scenario, the parallel market rate cools from the high 147,000s down toward the mid 145,000s to mid 146,000s per 100, and it holds there without immediately snapping back. That would suggest either official throughput is improving, or demand urgency is being satisfied, or enforcement is temporarily reducing street velocity. In that case, the spread compresses a bit, and the market tests whether the official channels can keep up. The tell is stability, it's boring, it's lower volatility. It's the market accepting a slightly lower clearing price. And that's where the real pressure starts, because the next move depends on whether that retest holds. Scenario 2 is the continuation squeeze. In this scenario, the market keeps printing above the high 147,000s and starts probing the 150,000 area. The volatility rises, not falls. Dealer spreads widen, quotes get thinner. You hear more stories of delays and restrictions, and fewer stories of smooth approvals. In that scenario, you're not watching for a big announcement. You watching for the mechanical consequence, forced buyers and hoarders colliding in a thin market. The tell is acceleration. It's consecutive closes near the highs. It's less mean reversion. And if that happens, you also have to respect gap risk, overnight policy tweaks, enforcement actions, surprise relaxations, sudden restrictions. The market can jump in either direction. And that's not the part that matters. The part that matters is what confirms each scenario without you needing to become a rumor addict. Confirmation for the controlled pullback is the market holding below the upper band, call it roughly the 148,000 area per $100, across several sessions, and doing so even after the weekend gap or the next payroll large trade window. Confirmation for the squeeze is repeated failures to stay below the mid 146,000s once liquidity returns, combined with quick rebounds after any dip. Invalidation is the opposite. If you expect compression and the market keeps snapping back to highs, your compression thesis is wrong for now. If you expect squeeze and the market bleeds lower and stays lower with calm, you don't keep yelling squeeze out of pride. You adapt. That's how you survive this. Now let's talk about the why now trigger again, because it's the bridge between theory and timing. Early January is a classic stress zone. Administrative resets, budget chatter, settlement cycles, and the psychological overhang of new rules. In Iraq specifically, when the official anchor is reiterated for the budget, it has a strange side effect. It can increase the incentive to fight for allocation at the official channel because the official channel is now visibly valuable. If you can get dollars near the anchored rate while the street is much higher, the temptation to access and redirect grows. So authorities respond by tightening supervision to prevent leakage. Tightening slows throughput. Slower throughput pushes real demand into the street. The street spikes. Then authorities crack down to reduce the spike. That pushes activity back into banks, then banks clog, and around we go. It's a policy feedback loop, and once you see it, you can't unsee it. This is also why you should watch the policy mix, not just the rate. When officials talk about banning domestic dollar use, encouraging dinar settlement in big-ticket items like real estate and cars, routing transfers through correspondence, and expanding card usage, they're not just doing PR. They're trying to change the shape of demand. They want fewer people needing cash dollars. They want more people using formal rails. That can work over time, but in the short run, it often creates transitional stress because the old informal network doesn't disappear overnight, and the new formal network doesn't instantly become frictionless. The transition period is where spreads widen. That's the hidden mechanism that the mainstream misses, not devaluation expectations, but transition friction. Now let's bring in one more layer of proof, the regional consistency. When Baghdad and Erbil are both printing similar elevated levels, that tells you this isn't just a local dealer story. It's systemic demand. It's a broader liquidity condition. If it were purely local, you'd expect bigger divergence between regions as arbitrage within the country pulls prices around. When they move together, it suggests the constraint is upstream: channel access, overall availability, national policy, and banking throughput. And that's where the real pressure starts. Here's another layer, the way authorities talk about the remaining gap. You'll often hear claims that the gap is just transaction costs once it compresses to a few percent. That's partly true in calm periods, but when the gap jumps double digits, it's not transaction costs. It's access risk. It's settlement risk. It is the market charging you for the probability that you can get dollars when you need them. And that is exactly why spreads can widen quickly, even if the official story is stable. So what comes next, practically? Without you turning into a full-time Dinar watcher, you build a near-term roadmap and you stick to it. Over the next week, watch whether the parallel market can hold below the upper stress zone after the next obvious liquidity events. weekend gap, payroll timing, and the next import settlement wave. Watch whether dealers are quoting tighter spreads or wider spreads at the street level. Watch for any operational announcements that increase official channel throughput, simplified procedures, expanded eligible categories, clearer documentation requirements. Those are bullish for compression. Also, watch for the opposite. Reports of more rejections, longer delays, more categories being restricted, or enforcement that pushes people away from informal dollars without providing a fast formal substitute. That's bullish for a squeeze. Over the next 2 weeks, watch whether policy pressure rises. The more consumer prices react, the more political urgency rises, and the more likely you are to see abrupt measures. Abrupt measures can compress the spread quickly, but they can also create whiplash. And this is where viewers get emotionally manipulated again. A sudden drop in the street rate can feel like problem solved, and a sudden spike can feel like collapse. Both emotions can be wrong, but the truth usually lives in the follow-through. Does the market stay compressed, or does it rebound? Does it keep stressing, or does it mean revert? That's the signal, not the first reaction. Now, I want to be very explicit about something for the skeptics in the room. You don't need to believe any grand story to respect the spread. You don't need to believe in secret plots. You don't need to believe in magical revaluations or doom scenarios. You just need to respect incentives and plumbing. The incentive is obvious. When an official channel offers cheaper dollars than the street, everyone wants access. The plumbing is obvious. The system tries to control that access to prevent abuse and leakage, and that control introduces friction. Friction creates a premium. That premium is the spread. Full stop. The spread is the truth serum. And that's not the part that matters. The part that matters is what you do with it. If you're a macro watcher, the spread tells you about domestic financial stress and the effectiveness of reforms. If you're a commodities and metals crowd member, you should care because FX access affects import pricing, trade flows, and inflation impulses, which feed into broader macro positioning and risk appetite. If you're a retail investor, skeptical of institutions, this is a clean example of how official reality and market reality can diverge without either side lying. Because the real battle is over access, not slogans. And if you're simply trying to stay sane in a world of volatility, then treat this as a masterclass. Markets don't just move on headlines. They move on constraints. So here's your final checklist. Simple enough to run in your head, strict enough to keep you from getting emotionally hijacked. First, track the spread, not the official quote. The official anchor can stay steady while stress rises. The spread will tell you first. Second, watch the zone. Sustained prints above roughly 148,000 per $100 are stress. Sustained acceptance below the mid-146,000s with calmer behavior is cooling. A push toward 150,000 and beyond is escalation and headline risk. Third, watch for follow-through after calendar events. If the market stays elevated after a weekend gap and after the next settlement wave, the pressure is real. If it fades quickly and stays faded, it was an air pocket. Fourth, listen for throughput signals, not promises. We are stable is a promise. We expanded eligible categories. We clarified documentation. We increased bank channel capacity. We improved customs processing. Those are throughput signals. Throughput moves the spread. Fifth, respect volatility. Even a correct thesis can whip you around. Use a two-scenario lens. Controlled pullback and retest versus continuation squeeze. Don't marry one path. Let confirmation choose for you. And finally, keep your identity clean. Don't be the person who chases fear and sells relief. Be the person who watches mechanisms, waits for confirmation, and stays calm when everyone else gets loud. That's the edge in markets like this. Not secret information, but emotional discipline and a clean model. If you want a community that thinks this way, mechanisms first, checklist first, no fairy tales, stick around. Drop your key level in your own notes, not as a prediction, but as a trigger. If it holds above X, I treat stress as persistent. If it loses Y and stays there, I treat stress as cooling. That's how you stop the market from stealing your decision-making. And remember the hidden detail that started this whole story. The official rate is an allocation, and the spread is the price of access. Once you watch access, you stop getting blindsided by headlines.